right. So we skip over chapter 8 and we go on to chapter 9, business income deductions and accounting methods. It's kind of a long chapter, so I'll probably break this up into two recording sessions. And so first thing is to note here is that chapter 9, the issues we deal with here are related to all business entities and how they treat income deductions and accounting methods. Now, when it deals with, or when it comes to taxation of individuals, the type of business entity that we're talking about could be sole proprietorship. We've talked about that a little bit. Could be a flow-through entity, a partnership, or an LLC, or an S Corp. But the bottom line is that the issues we discuss here are issues that arise in all types of business structures, business entities, not just those types that affect taxation of individuals. So just keep that in mind, that these rules apply, and you'll use some of these rules and some of these issues we'll deal with in taxation of business entities if you take that course. So, and I hope you will. So anyway, if you recall, when you have a sole proprietorship structure, I guess the key phrase you hear there is you're in business for yourself, which is pretty much true. You're responsible for income deductions and losses, gains in your personal income tax form 1040 with attachments, most notably Schedule C. And so if you look at Schedule C, if you recall, you have to list your revenues, and then you take from that your costs of goods sold if you have a product you sell. Now, if you're in the service industry, you don't have any cost of goods sold. And so for service industries, your gross profit is essentially your gross receipts. Now, and you know, again, the same idea as far as what's included in business income. We looked at some concepts such as when must you, in what period must you include income in your taxable income? Well, the same idea for individuals goes for an individual who's in business. In other words, if you have a customer who has a check ready for you to pick up or something like that, and you simply wait till the next year, you cannot avoid declaring that as taxable income in the year that it was made available to you. As far as deductions are concerned, we have some requirements as to what can and can't be deducted. And so the first requirement for a deductible business expense is that there has to be some sort of business activity that its intended purpose is to make a profit. Again, we looked at hobby losses, hobby deductions, and what all that entails. So just remember, for it to be a deductible business expense, it has to be related to an activity that is meant to make a profit. On top of that, the deduction, the expense related, must be reasonable. And it must be ordinary and necessary. Now I'm going to flip back here. What does it mean for a deduction to be ordinary and necessary? Well, it's a little broader than what you might think. And so a deduction or an expense is ordinary if it's normal or appropriate for the business under the circumstance. Notice it's not required to be typical or repetitive, so it could be a one-time deal, such as paying a lawyer for their services related to a business litigation. Certainly that's not something you would want to have very often, or if you do, you have to question how you're running the business. But it's not uncommon to be sued in some sort of manner related to your business. So certainly it would be expected to hire an attorney if you have business-related litigation. And so it would be considered ordinary, even though you're doing it just one time. On top, and it's got to meet every one of these requirements in order for the expense to be deductible. Okay, so it has to be some for-profit activity, has to be ordinary, and it has to be necessary. An expense is necessary when it is helpful or conducive to the business activity. It need not be essential or indispensable, though. And so the example they use is a mechanic who works mostly on American cars, so he's got his regular tools, but every once in a while he might work on a foreign car where you need, for instance, wrenches that are metric in their measure. And so that's certainly not something that is indispensable. I mean, he could just not ever work on foreign cars. but it certainly is helpful or conducive to his business activity. And so for that reason, it is considered necessary. And note, the book points out that the IRS isn't in the business of second guessing business decisions on what is deductible and what's not deductible. I wouldn't agree with that totally, but in close calls, certainly they're going to lend some deference to the business person. And so they give in example 9-1 or exhibit 9-1 some examples of typical ordinary and necessary business expenses: advertising, car and truck expenses, depreciation, employee compensation and benefits, insurance, and you know, they could be health insurance, they could be property and casualty insurance, you know, depending on the type of business you are. Let's say you're a sole proprietor CPA, malpractice insurance would be ordinary and necessary. Not to say you have to use it or would want to use it, but it's definitely considered ordinary and necessary in the business. Legal fees, office expenses, rent, repairs, supplies, travel, utilities, and wages are all also considered ordinary and necessary business expenses. Okay, so has to be a profit motive, has to be ordinary and necessary. On top of all that, the expense must be reasonable in amount. Now, what does it mean to be reasonable in amount? Well, it must not be extravagant. It must not be over what a normal person in the same or similar situation would pay for that expense. Well, again, you might ask yourself, why would anybody pay more than they really have to for an expense? I mean, you're just hurting yourself, aren't you? And the answer is yes, you are. And so, as a general matter, this practical matter, this only comes up in cases where, in numerous occasions, what you'll see is business owners paying family members excess amounts that are over what the IRS considers a reasonable amount you would pay in an arm's length transaction. Well, why would you pay your family member more than a reasonable amount? Well, again, back to the issue of income shifting. If you can shift income from the owner who probably is at a high tax rate to, let's say, a child, let's say an adult child who's in a lower tax break or tax rate, there's some opportunities there to shift income to the lower tax rated family member. So that's usually where that comes up. Notice on page 4, taxes in the real world, what qualifies as a business. this kind of stretches the limits of what is a business, what is a for-profit endeavor. But look at that. There's some pretty novel cases. I keep waiting for someone to write a paper on interesting and novel and sometimes funny court cases, because they're out there. All right, so as long as the expense is related to some business activity and it's ordinary, necessary, and reasonable, you should be able to deduct the expense, right? Well, yes, with exceptions. Again, this is tax law. You have your general rule. The general rule here is that a business expense is deductible if it's ordinary and necessary and reasonable. And then you have your exceptions to the general rule. And so that's this next part. Here's an example, by the way, of this reasonable issue. Rick owns a business that employs his brother, Ben. Ben is paid $45,000 per year by Rick's business. In comparison, other employees with Ben's responsibilities are paid only $30,000 per year. What is Rick's business deduction for employing Ben? Well, in this case, it's $30,000. Does that mean Rick can only pay Ben $30,000? No, it just means that Rick can only deduct the $30,000 of the $45,000 that he pays his brother. And so the $15,000 extra is a gift from Rick to Ben. As we will see when we get to taxation of business entities, if Ben, of course this is a sole proprietorship here, so this is not applicable, but when you get to business entities and you have more than one owner, and Ben is an owner of the business, one of the owners of the business, how is that $15,000 going to be treated? Well, it kind of depends, but if this were a corporation and Ben was paid excess $15,000 over what's reasonable, that $15,000 would be considered a dividend. So, but for our purpose here, it's a gift. All right, so here are the exceptions to business deductions. Expenses that are against public policy. There are certain expenses that a taxpayer must pay, even in a business-related setting, that the government doesn't want to glorify or somehow promote certain activities. And so it falls under this expenses related to against public policy. And so the first one of these is bribes and kickbacks. What's a bribe? Well, it's where you give money or some other form of compensation to a public official, and you're doing so in return for that public official doing something favorable for you. I mean, is that the technical definition? No, but that's close enough. There's a quid pro quo there. I pay you money and you make a decision that's favorable to me, such as a public works contract. I'm a road builder, and I want this state contract to build this road, and so I go to the official who's responsible for deciding who gets the contract, and I say, I'll pay you $5,000 if you select me to build the road. Well, there's a quid pro quo there, and so bottom line is you would not be able to deduct that bribe as an expense. Kickback, kind of the same deal. It's where usually you're paying excess, and that excess goes to a public official. The payment of fines and penalties are non-deductible. Again, Congress doesn't want to encourage the activities that are related to the incurring of fines and penalties. So they don't allow you to deduct those as business expenses. Political contributions and lobbying costs, for the most part, are non-deductible. And so if you want to give money to, you're in business and you want to give money to a politician who's running for office or running for re-election, you can certainly give them money, but you cannot deduct that as a business expense, even though the person you're backing may actually help your business. What is lobbying? Well, usually this deals with issues that a business person thinks would be helpful to them. And so when that happens, certainly you can pour money into lobbying, but for the most part, that expense is not deductible, even though the lobbying may help you win some influence. Now, there is an exception to that exception when the hobby expenses relate to reasonable costs incurred in conjunction with the submission of statements to a local council with respect to proposed legislation of direct interest to the taxpayer. So there, you got a couple of things going on. It's got to be lobbying expenses related to submission of statements to a local council, city council, county commissioners, people of that sort, or organizations of that sort that you're lobbying. And on top of that, the proposed legislation must be of direct interest to the taxpayer. Well, what does that mean? Well, let's say let's say the county commissioners are about to change the zoning laws to where you're no longer going to be able to run your business as you have. Well, that proposed legislation would be of direct interest to you, and the submission of statements, the lobbying, would be to a local council. So in that case, you should be able to deduct reasonable expenses for the lobbying costs. And they have some examples there, example 9-3. Take a look at those. Let's see, where are we? Okay, so this is like a 33-page chapter. So I'll go to probably page 16. So I've got a little ways to go. Capital expenditures are not deductible in the year incurred. This is just like financial accounting rules, GAAP. If you have a capital expenditure, what do? Well, you list it as an asset on your balance sheet. Well, how do you deduct the cost? Well, you deduct the cost of the capital asset over the expected life of the capital asset. And we'll get into depreciation here in the next few chapters. But just keep that in mind. If it's a capital expenditure, you got to capitalize the asset and depreciate it over its useful life. Now, for tax purposes, the IRS dictates what that useful life is. You don't have the flexibility you do in financial accounting as far as that's concerned, but it's the same general principle. Now, is it easy to figure out what's an expense, deductible expense versus a capital expenditure? No, sometimes it's not easy. There's a gray area, and that's where you get into these disputes with the IRS concerning whether it's a deductible expense in the year the expense is incurred versus capitalizing and depreciating over what the IRS deems is its useful life. Moving on, personal expenses is the next one I want to talk about. You can't deduct and this seems like nothing but pure logic. You can't deduct as a deductible business expense your personal expenditures. But yet, when you get out there, you become a CPA and you deal with small businesses. And I've mentioned this before, one of the main issues you're going to have to deal with is getting your clients to listen to you and take your advice and to do it right. So many of these small businesses, sole proprietorships, have one checkbook, and they write checks for their business expenses out of it. They write checks for their personal expenses out of it, and it's just a big mess. So one thing to tell your clients right up front, hopefully they listen: segregate your business accounts from your personal account. Only write checks, only pay for business expenses out of the business account. If you need money for personal expenses, transfer money from the business account to the personal account and pay those personal expenses out of the personal account. So the main part in dealing with someone who's just gone into business is educating them on the proper way of doing things. All right, so back to capital expenditures. Just ask yourself if the benefit lasts more than 1 year. If so, you've got to depreciate it. Same for prepaid expenses, other types of prepaid expenses. Prepaid insurance, you pay for 2 years of insurance just like you would in financial accounting. You don't get to deduct that second year until the year that you benefit from that. So here we have an example of a prepayment. Insurance, $12,000 over the next paid for insurance over the next 24 months. That's going to have to be deductible. Half of that's going to be deductible in that next year. I'm not sure where this is in the book. Special business deductions, losses on disposition of business assets. If you get rid of an asset, dispose of it in some way, and you sell the asset for less than its basis, that is a loss and is fully deductible. Now notice, for business casualty losses, those losses are limited to the lesser of the decline in value or its basis. So it's the lesser of those two. If the asset in the casualty loss is fully destroyed, then the basis is the amount of loss in that business asset. We're not going to cover that. Let's see. One thing I want to talk about under personal expenses, and they didn't really, it's not really talked about in this, but I'm going to talk about it anyway. Educational expenditures. This is something that might interest you. When is an educational expenditure a deductible business expenditure? I'm a small businessman. I'm running a fairly growing business. I have a BA in, let's say, pick some topic. Architecture. I have a degree in architecture. but I'm the owner of my own architect business, and I'm learning that I need the business skills in order to be successful. So I look at an MBA program so I can hone those business skills that I don't really have. Question there is that educational expense to obtain that MBA a deductible business expense? And the answer is probably yes. It's about the closest answer I can give you. More than likely, yes. Let's put it that way. And so educational expenditures are not deductible as business expenses unless the education, number one, maintains or improves skills required by the individual in his employment or trade or business. Or two, meets the express requirements of the individual's employer or the requirements of applicable law or regulations imposed as a condition to the retention by the individual of an established employment relationship, status, or rate of compensation. So that's a mouthful. It says education necessary to meet minimum requirements for an occupation are not deductible. All right, so you want to be an architect, you go to school to become an architect, those expenses are not deductible because that is the necessary education to meet minimum requirements. Moving it closer to your interest, what if you have a degree like me in something other than business or accounting, and you decide you're going to become a CPA? As a matter of fact, you're working in an accounting department for a company, and everybody in the accounting department pretty much is a CPA. Well, that may be something I need to do, and I did. So I went back to school and got a master's in accounting and my CPA license. Does that mean I can deduct any of those things? Well, luckily for me, I had an employer who paid or reimbursed me for my educational expenses, but not everybody has that luxury. The answer is no, I couldn't, because the courses I was taking met the minimum requirements for CPA. Okay, well, let's say I graduate with an accounting degree and I take a CPA review course. Is that deductible? And the answer is no, because again, it's an educational expense that's necessary to meet minimum requirements for an occupation. Same goes for teachers. And so, well, what about MBA programs? I think an MBA would be really helpful to me in my job, and would help move me up the ladder. And right now I'm fairly low-level analyst. Is that deductible? And the answer is no, because basically it's preparing you for a new career as a, somewhere up the line manager in the company. Well, what if I'm a manager within the company, fairly high level, or at least mid to high level, and I need these skills to help me do my job? Can I deduct the cost of my MBA? And the answer is probably so, and more likely so in that case. So again, there's some black and white, but there's a lot of gray involved in this as well. Next, they go into what they call mixed motive expenditures. And here, what you have going on is maybe some personal benefit derived from the expenditure, as well as some business benefit being derived from the expenditure. And so they have several different types, and they've broken them down into meals and entertainment, and then travel and transportation. And so let's talk about meals and entertainment. For meals, taxpayers can only deduct 50% of the reasonable cost of actual business meals. And so notice it's got to be, it's got to meet all those requirements even to be able to deduct. It's got to be ordinary, necessary, and reasonable. It's got to have a business profit motive. You can't take your family out every night and expect to deduct it as a deductible business expenditure. It's got to be a client, a potential client, a potential supplier, someone, some party related to your business that could be helpful to your business. If so, if it's reasonable and it's related to your business, then you get to deduct 50% of that business meal. A couple other requirements for business meals is that the taxpayer must be present when the meal is furnished. I'm not quite sure what's going on there. I guess they don't want the taxpayer giving money to someone else and say, here, dinner's on me. Because certainly if that's the case, there's not a whole lot of business going on related to that meal. As far as entertainment is concerned, back to meals. Last but not least, the meal must be directly associated with the active conduct of the taxpayer's business. Well, I think I kind of mentioned that already. You can't be taking your family members out for dinner and expect to deduct 50%. It's got to be associated with the active conduct of the taxpayer's business. All right, now to entertainment. What do they mean by entertainment? Well, this could be taking a client or potential client out to a play, a musical, I mean, in some business, I was in the energy business, and I hate to say it, but a lot of the salesmen in that field used to take their clients out to strip clubs. So, you know, you might find that objectionable. I certainly do. I certainly don't think strip clubs are entertaining, but I guess in the energy business, if you want to get business, you take your client out to a strip club. So anyway, question is, isn't there enjoyment gotten from that? And isn't that personal in nature? And the answer is yes. But as long as you meet the requirements, you get to deduct 50% of the entertainment expense. So what are the requirements? It says entertainment deductions are allowable only if business associates are entertained. So what's a business associate? Well, it's got to be somebody that's going to either be a client or is a client, that sort of thing. A supplier would be certainly a business associate as well. Again, the amounts paid must be reasonable. And then 3, this is where you usually get into an argument with the IRS. The entertainment must be either directly related to or associated with the active conduct of a business. And so it says the cost of entertainment that occurs in a setting with little possibility of conducting a business discussion, where it's either very loud or in some cases you've got to be quiet during the entertainment and can't talk at all. The business discussion in that setting must occur only if the entertainment directly precedes or follows a substantial business discussion. On top of all that, you've got to keep good records, and this is true for meals as well as in entertainment. Who you were with, where you went, what was discussed, and copies of receipts. Moving on to travel and transportation. So, transportation expenses include the direct cost of transporting the taxpayer to and from business sites, but note that if it's considered commuting expenses, it's not deductible. So let's say you're a regional manager. Your routine during the day is you come into the main office, you drive 30 miles, and then from there you go out to your various locations. Well, that 30 miles to and from your main location is considered a commuting expense and not deductible. The travel cost to travel to these other locations, though, is deductible. Now note, you can deduct the actual costs of travel, or you can opt for a standard mileage rate, which in 2015 is 57.5 cents per mile. And note that the transportation must be business related. What about travel expenses? This is when you're traveling out of town, usually overnight. And so that's the big difference between travel and transportation expenses. You're taking a plane to a different city and you're staying in a hotel, that sort of thing. And so you have to discern the two, because not only do you get to deduct if it's a transportation expense, if it's a travel expense, you get to deduct the cost of transportation, you get to deduct meals, 50%, lodging, and incidental expenses. Notice it says that a taxpayer is considered to be away from home overnight if the travel is away from the primary place of business and it is of sufficient duration to require sleep or rest. So, if you're traveling 60 miles from your main office, is that considered deductible? And the answer is probably not, since you could probably drive back home after your things that you do. If it's 150, 200 miles, yeah, that's probably going to be a travel expense and fully deductible, except for the meals, which is only 50%. All right, property use. And here you're using your property in your business. A good example is you use your car for both business and personal. For business purposes, you only get to deduct the mileage or the expenses related to the business portion. In other words, if you traveled 12,000 miles in a year and 7 of those were for business, you would only get to deduct 7,000 miles, either the actual cost or standard cost or standard deduction, mileage deduction. The main key there is, and look at example 9-9, you got to keep good records of this stuff. This usually comes into effect where you've got like a realtor or somebody like that who may be good at selling homes, but they really are not very good at record keeping. You've got to keep stringent records of your business mileage and your business activity, detailed records, and they have to be contemporary. They can't be making them up when they're in an audit 2 years after the year in question. So that's another thing that you have to do for your clients. I think I'm going to end there, and I'll pick it up talking about losses on disposition of business property. I think I've already talked about those. So we'll move to page 15, accounting periods, next time.